There's a number sitting on a chart right now that should be terrifying every single investor in America. And almost nobody's talking about it. It's called the misery multiplier. Once you understand what it actually measures, you'll never look at a stock market rally the same way again. Here's the setup. For the last year and a half, two completely unrelated things have been happening in the American economy at the exact same time. Home insurance premiums in states like Florida, California, and Louisiana have spiked by an average of 40 to 60%. And in that same window, the S&P 500 has printed something like 24 fresh record highs. On the surface, those two facts have nothing to do with each other. One is about roofs and hurricanes. The other is about tech stocks and earnings calls, but stick with me. Because by the end of this video, I'm going to show you how these two stories are actually the same story, just wearing different clothes. And once you see the connection, you'll understand something most retail investors completely miss. The stock market going up does not always mean you're getting richer. Sometimes it means the ruler you're using to measure your wealth is shrinking. Before we go further, I want you to do something. Pull up your own portfolio app right now if you have one open. Look at the percentage gain for this year. Now hold that number in your head, because we're going to come back to it. And I promise you'll look at it differently by the end of this video. Let's start with a thought experiment, because I think this is the clearest way to understand what's actually happening. Imagine you own a bakery, and every single day you bake exactly 100 loaves of bread. Today, let's say each loaf sells for $5. So your daily revenue is $500. Now imagine that overnight, for reasons that have nothing to do with your bakery, the value of the dollar itself gets cut in half. Suddenly, to buy the same amount of flour, butter, and eggs you bought yesterday, you now need $10 per loaf just to break even. So you raise your prices. You're now selling the exact same 100 loaves for $10 each. Your revenue just doubled to $1,000 a day. If you only looked at the top line number, you'd think business is booming. But nothing about your bakery actually improved. You didn't bake more bread. You didn't get more customers. You didn't build a second oven. All that happened is the currency you're counting your success in became worth less. This is, in miniature, exactly what a lot of people believe is happening across the entire US stock market right now. And the bakery analogy isn't just a cute story. There's real historical precedent for this exact phenomenon. And it's one of the strangest chapters in financial history. Let's talk about Weimar Germany in the early 1920s, because this is the most extreme version of this pattern that has ever been recorded. Between 1921 and 1923, German inflation became so severe that prices were doubling every few days. Think about that for a second. Not doubling every year, not every month, every few days. People would get paid and rush straight to the store before their wages became worthless by lunchtime. There are stories of workers being paid twice a day, once in the morning, once in the afternoon, because waiting until the end of the day meant your wages might lose a third of their value. There's an old story, often repeated, of a woman who used a wheelbarrow full of cash to buy groceries. She set the wheelbarrow down for a moment outside the store. And when she turned around, someone had stolen the wheelbarrow, but left all the cash sitting on the ground. That's how worthless the paper itself had become. And here's the part almost nobody mentions. During that same hyperinflationary collapse, the German stock market, measured in German marks, went up by an almost unbelievable amount. If you had only looked at the raw stock index, you would have thought German companies were having the best years in their history. But when economists later adjusted those same stock returns for the collapsing value of the mark, the picture flipped completely. They measured performance in gold instead, or in stable foreign currencies like the US dollar or British pound. And German stocks, in real terms, actually lost the vast majority of their value during that period. The nominal chart was going vertical, while the real chart was collapsing. Same market, same companies. Two completely different stories, depending on which ruler you use to measure it. Now, I am not saying the United States in 2026 is Weimar Germany. That comparison gets thrown around far too casually online. And it's usually wrong. The scale is nowhere close, and the institutions backing the US dollar remain far stronger. But the mechanism, the actual mathematical relationship between currency devaluation and nominal stock prices, is identical. It's just operating at a much smaller, much slower scale. Let's look at a second historical example, one that's a little closer to home and a little less extreme. Argentina, over the past several decades, has lived through repeated cycles of currency devaluation, and every single time, the local stock market, measured in Argentine pesos, has soared to new record highs. Local headlines celebrate the record highs, but measure that same stock market in US dollars instead of pesos. And the picture looks completely different. Argentine investors have learned this lesson the hard way, over and over again. A rising number in your local currency means almost nothing if that currency is collapsing faster than the number is rising. This is sometimes called phantom growth, and it's a pattern that shows up again and again throughout financial history, in dozens of different countries. Turkey has experienced something remarkably similar in recent years. Its stock market has repeatedly hit record highs in Turkish lira, while the lira itself has lost a huge share of its value against the US dollar over the same period. Investors who stayed purely in lira felt like winners. Investors who measured their returns in dollars often found they had actually lost purchasing power. So let's bring this back to today and look at what's actually happening in the US economy right now, piece by piece. Start with something that affects real people in a very tangible way: insurance. Over the past 3 years, dozens of major insurers have either pulled out of high-risk states entirely or dramatically hiked premiums for the customers who remain. Reconstruction costs for homes have risen sharply because lumber, copper wiring, roofing materials, and skilled labor all cost significantly more than they did 5 years ago. That is inflation, not the headline number you see on the news. The actual lived, real-world cost of maintaining the life you already had. Now pair that with grocery bills. A basket of groceries that cost an American family around $100 in 2019 costs meaningfully more than that today, even after the inflation has cooled headlines you've been reading. Think about the last time you filled a shopping cart. Did it feel fuller than it used to for the same amount of money? Probably not. And that gap between how full your cart feels and what the headlines tell you is exactly the disconnect we're exploring today. The Federal Reserve's preferred measure of inflation may have come down from its 2022 peak. But coming down from a peak is not the same thing as prices going back down. Prices very rarely go back down. They just stop rising as quickly. That distinction matters enormously, and it's one of the most misunderstood concepts in economics. Think of it like a car that was accelerating at 80 miles an hour, and now it's only accelerating at 20 miles an hour. It's still accelerating. It's still speeding up. It has not stopped, and it has certainly not reversed. Here's another way to picture it. Imagine you're on an escalator that's still moving upward. Someone tells you, "Don't worry, the escalator has slowed down." That's true, it has slowed down, but you are still being carried upward the entire time. Slower inflation is not the same as falling prices. It's simply a slower climb up the same escalator. So while the media narrative has largely settled into inflation is basically handled, something else is quietly still happening. The purchasing power of $1 in your pocket keeps eroding, just at a less dramatic pace than it was in 2022. Now here's where it gets interesting, and here's the connection back to that stock market chart. When the value of a currency erodes and companies sell goods and services priced in that currency, something predictable happens. Their revenue numbers, measured in that currency, tend to rise, even if they're not actually selling anything more than before. It's the bakery story again, just happening across thousands of publicly traded companies simultaneously. A company doesn't need to sell a single extra unit of anything to report higher revenue in a weakening currency environment. It just needs to raise prices in line with its rising input costs. And when revenue rises, even for reasons that have nothing to do with genuine growth, stock prices tend to follow. This is one of the most underdiscussed forces in modern investing. Currency debasement can manufacture the appearance of growth without any of the substance of growth. Let's make this even more concrete with a second, smaller thought experiment. Imagine two identical twin companies operating in two different countries. Company A operates in a country with completely stable prices, zero inflation, year after year. Company B operates in a country where prices rise 5% every single year, like clockwork. Both companies sell the exact same number of widgets every year for a decade. No growth in actual units sold, no new customers, no expansion. Company A's revenue chart in its local currency would look almost perfectly flat for 10 straight years. Company B's revenue chart in its local currency would look like a steadily climbing staircase. Any investor glancing quickly at Company B's chart would assume it's the better, faster growing business, but it isn't. It's selling the identical number of widgets as Company A. The only difference is the currency it's counted in is losing value faster. This is exactly the trap that nominal stock charts set for casual investors every single day. And it's worth pausing here to ask yourself an honest question. How many stocks have you bought over the years purely because their revenue chart looked impressive? Did you ever stop to check whether that growth was real or whether it was simply pricing power catching up to rising costs? Most people never ask that question, which is exactly why this illusion works so well on such a large scale. Now let's look at this from a completely different angle, bond markets. Because this is where the smart money quietly tells a very different story than the stock market does. Government bonds are essentially IOUs. When you buy a U.S. Treasury bond, you are lending money to the government in exchange for a promise of repayment plus interest at a later date. When investors trust that a currency will hold its value over the life of that bond prices tend to stay relatively stable. But when big institutional investors start to suspect something else, the picture changes. They start to suspect that the currency they'll be repaid in will be worth meaningfully less by the time that bond matures. So they demand a higher return to compensate for that risk, and that pushes bond prices down. Over the past couple of years, we've watched exactly this kind of pressure build in the Treasury market. Long-duration bonds, the ones that won't mature for 10, 20, even 30 years, have taken a real beating. That is not the behavior of a market that feels confident and calm. That is the behavior of a market that is quietly repricing risk, while the stock market keeps throwing a party upstairs. Think of it like a building with 2 floors. Upstairs, everyone's celebrating record highs, popping champagne, taking photos for social media. Downstairs, in the basement, the structural engineers are quietly checking the foundation and frowning at what they're finding. Both floors are real, both floors matter, but only one of them is telling you what's actually happening to the building itself. Add to that another data point worth paying close attention to. The steady stream of central banks around the world, from China to India to several Gulf nations, increasing their gold reserves at the fastest pace in decades. Central banks do not buy gold because they're bored. They buy gold when they want a store of value that exists completely outside of any single government's currency policy. Gold doesn't pay interest. Gold doesn't have earnings reports. Gold doesn't grow or expand its business. So the only reason a central bank stockpiles more and more of it is to hedge against currency risk. When you put these pieces together, a fascinating and slightly unsettling picture emerges. Bonds are being sold, gold is being hoarded, and yet stocks keep hitting new highs. That is not 3 unrelated data points. That is one single story being told 3 different ways. The story is this: trust in the long-term value of the currency itself is quietly eroding, even while the assets priced in that currency appear to be thriving on the surface. Let's talk about oil for a moment too, because commodities tell a related piece of this puzzle. Historically, when a currency weakens meaningfully, commodities priced in that currency often rise in tandem, simply due to the math of the exchange rate. Oil, copper, wheat, and other raw materials become more expensive in dollar terms. Not necessarily because the world suddenly needs more of them, but because it now takes more devalued dollars to buy the same barrel or the same bushel. Watching commodity prices alongside currency strength is another way savvy investors triangulate what's really going on beneath the headlines. Now, let's talk about corporate profit margins, because this is where we can actually test whether real growth is happening underneath all of this. If a company's profits are genuinely growing, you should see that show up in something called real earnings, meaning earnings adjusted for inflation, not just the raw dollar figure. Here's an interesting historical comparison that I think puts this in perspective. Look at the late 1970s in the United States. Nominal corporate profits during that period looked reasonably healthy on paper. Companies were reporting rising dollar revenues year after year. But once you adjusted those same profits for the inflation raging through the economy at the time, the picture changed entirely. Inflation ran roughly 7 to 13% annually depending on the year, and real inflation-adjusted corporate profitability was essentially flat to declining for much of that decade. Investors who only watched the nominal numbers felt like they were participating in a growing economy. Investors who adjusted for inflation could see they were standing still or worse. And when the Federal Reserve under Paul Volcker finally stepped in the early 1980s, everything changed at once. He aggressively raised interest rates to crush inflation. Interest rates climbed above 19% at their peak, a number that sounds almost fictional today. And the stock market had to reckon with reality all at once. It was a brutal, painful adjustment for anyone who had been fooled by the nominal numbers. Millions of Americans lost jobs during the recession that followed. But inflation was eventually brought under control, and it set the stage for the long bull market that followed through the 1980s and 1990s. That's an important detail too. Painful corrections, historically, have often cleared the way for healthier growth afterward, which is a reminder that these cycles, however uncomfortable, are not necessarily permanent disasters. They're part of a longer rhythm that markets have moved through before. I bring this up not to predict doom, but to illustrate a pattern that recurs throughout financial history. Nominal growth built primarily on currency weakness eventually meets a moment of reckoning. Sometimes that reckoning is gentle, a slow, grinding correction over several years. Sometimes it's sharp, like the dot-com collapse in 2000 and 2001, when stock prices that had drifted enormously far from actual company earnings snapped back down in a matter of months. Let's actually sit with that dot-com example for a moment longer, because it's one of the clearest case studies we have. In the late 1990s, plenty of internet companies were trading at valuations that assumed decades of future profit growth that hadn't happened yet. Investors kept bidding prices up, convinced that the old rules of valuing a business simply didn't apply anymore. For a while, the market seemed to agree, and prices climbed higher and higher. Companies with no profits, sometimes no revenue at all, reached billion-dollar valuations. The justification at the time was always some version of, "this time is different." It rarely is. But eventually, actual earnings reports came due, and many of these companies simply couldn't produce the profits the stock prices had already assumed. When reality and valuation are stretched far enough apart, Something eventually has to give. And historically, it's always the price that corrects downward to meet the earnings, never the other way around. Earnings don't magically leap upward to justify a stock price. Prices fall back down to where the earnings actually are. That's simply how the math of investing eventually resolves itself. So the real question for anyone watching the market today isn't, why are stocks going up despite the uncertainty? The more useful question is this: what happens to profit margins if this currency weakness continues? Or worse, what happens if it reverses unexpectedly? Let's break that into two distinct scenarios, because this is genuinely the crux of the entire issue. Scenario 1, currency weakness continues, and the broader economy keeps growing at a modest, positive pace. In this scenario, companies keep passing rising costs onto consumers through higher prices. Revenue keeps climbing in nominal terms, and the stock market likely continues its slow grind upward. Even if real, inflation-adjusted growth stays fairly muted underneath the surface. This is, frankly, the scenario that tends to reward staying invested, uncomfortable as it is to say. A modestly weakening currency combined with a growing economy has historically been a decent, if unspectacular, environment for nominal stock returns. Scenario 2 is a very different animal. Currency weakness continues, but the underlying economy actually tips into contraction. This is the dangerous combination, because now you have rising costs squeezing companies from one direction, and falling consumer demand squeezing them from the other direction. Profit margins get crushed from both sides simultaneously. Historically, this is the environment that produces the sharpest, fastest stock market declines, because there's no growth story left to justify the elevated prices. Think of it like a rubber band. Scenario 1 is a rubber band being stretched slowly and consistently, uncomfortable but survivable, even sustainable for a surprisingly long time. Scenario 2 is that same rubber band being stretched while someone is also cutting little notches into it with scissors. It might hold for a while, but when it finally snaps, it snaps violently, and usually with far less warning than people expect. Let's add a third, less discussed scenario, because reality often doesn't fit neatly into just two boxes. Scenario 3. Currency weakness suddenly reverses, and the dollar strengthens rapidly instead. This sounds like good news on the surface, and in some ways it is. But a rapidly strengthening currency after a long period of weakness can also create shocks of its own. Companies that had been enjoying the tailwind of rising nominal revenue suddenly lose that tailwind overnight. Their revenue growth, measured in the now stronger currency, can suddenly look far weaker than investors expected. This is sometimes called reverse currency shock, and it has caught plenty of investors off guard throughout history. So even a strengthening dollar, while healthy in many respects, isn't automatically a stress-free outcome for stock prices in the short term. So which scenario are we actually in right now, in the middle of 2026? The honest answer is that the data is genuinely mixed. And anyone who tells you with total confidence which way this breaks is overselling their certainty. On one hand, broader measures of economic output in the US have remained in modestly positive territory, which historically has been consistent with scenario 1, the uncomfortable but survivable path. On the other hand, several leading indicators have been sending more cautious signals over the past couple of quarters. Things like manufacturing new orders, small business hiring intentions, and consumer credit delinquency rates. All of these tend to move before the broader economy does. This is precisely why professional investors obsess over what are called leading indicators, rather than just watching the headline growth number, which tends to be one of the last things to turn. It's a bit like watching storm clouds gather on the horizon while the sun is technically still shining directly above you. The sunshine is real, but it's not the whole picture, and it's definitely not a guarantee about what happens next. Let's add one more layer to this, because there's a psychological piece here that deserves its own attention. There's a well-documented behavioral tendency called money illusion. It describes the human habit of thinking about wealth in nominal terms rather than real, inflation-adjusted terms. Economists have studied this for decades, and the findings are remarkably consistent. People genuinely feel happier receiving a 5% raise during 4% inflation than a flat salary during 0% inflation, even though the second scenario leaves them with more actual purchasing power. Our brains are simply wired to focus on the bigger number, not the number after you've done the harder mental math of adjusting for inflation. This is exactly why a rising stock market feels so reassuring, even when a meaningful chunk of that rise is just currency weakness in disguise. Understanding money illusion is like putting on a pair of glasses that suddenly lets you see the actual shape of the room you're standing in. Once you see it, you can't easily unsee it. Here's a small experiment researchers have actually run to demonstrate this. They asked people whether they'd rather receive a job offer with a 2% raise during a year of 0 inflation, or a 5% raise during a year of 4% inflation. Mathematically, the first option leaves you better off, but a striking number of people instinctively choose the second option anyway. Because 5% simply feels bigger than 2%, even though the real purchasing power math says otherwise. That single bias, multiplied across millions of investors looking at stock charts, is a powerful force. And it's a force that markets, whether intentionally or not, seem to exploit again and again. Let's bring in one more concept here, the idea of real yield. Real yield simply means the return you get after subtracting inflation. If a bond pays you 5% interest, but inflation is running at 4%, your real yield is only about 1%. For much of the past couple of years, real yields on cash and short-term bonds have been historically thin, which pushes investors to search elsewhere for returns that actually outpace inflation. And one of the few places large pools of capital can go searching for that is, you guessed it, the stock market. This creates a kind of forced migration of capital, not necessarily because stocks are cheap or safe, but because everything else on offer is barely keeping up with inflation or losing to it outright. That's yet another force quietly inflating stock prices that has very little to do with company performance. So where does that leave an everyday investor? Someone watching their retirement account or their brokerage app, trying to make sense of headlines that seem to contradict each other every single week. I think there are several genuinely useful practical takeaways here, and none of them require you to predict the future perfectly, because nobody can do that. Takeaway number 1, stop measuring your wealth using only nominal numbers. Get in the habit of asking, how is this actually performing after accounting for the currency losing value? If your portfolio is up 8% this year, but the real cost of living for your household has risen by 6%, you have not actually gotten 6% richer. You've gotten roughly 2% richer. And that's a very different feeling once you internalize it. Try this simple habit going forward. Every time you check your portfolio's percentage gain, subtract the current inflation rate from it in your head. That adjusted number is a far more honest picture of your actual progress. It takes 10 seconds, and it will change how you see every green number on your screen from now on. Takeaway number 2, pay attention to bond markets and gold, not just the stock market, because they often reveal what large institutional players actually believe about currency stability, well before that sentiment shows up in stock prices. When you see stocks rising while bonds and alternative stores of value are simultaneously signaling distrust, that divergence itself is meaningful information. It's not something to panic over, but it is something worth understanding and watching over time. You don't need to become a bond trader overnight. Simply glancing at how long-term treasury yields are moving alongside gold prices once a month gives you a much fuller picture than the stock market alone ever could. Takeaway number 3, diversification across different types of assets has historically been one of the most reliable tools available. In some cases, that means diversification across different currencies and geographies as well. This is proven, over long stretches of financial history, to help protect real purchasing power during periods exactly like this one. This isn't a call to abandon stocks. It's not a call to make some dramatic, fear-driven decision either. It's simply a reminder that no single asset class tells the complete story on its own. Takeaway number 4, and this one is often overlooked. Pay attention to your own spending, not just your portfolio. Track how much your actual monthly expenses have risen over the past 2 or 3 years. That number, your own personal inflation rate, is often more useful to you than any government statistic, because it reflects your actual life, your actual grocery bill, your actual insurance premium, not a broad national average that may or may not reflect your specific situation. Takeaway number 5, be skeptical of any single chart that seems to tell a simple, satisfying story. The stock market chart alone tells you almost nothing on its own. It only becomes meaningful once you place it alongside currency, strength, bond yields, and real corporate earnings. Financial literacy, at its core, isn't about predicting the future. It's about asking better questions of the data you already have in front of you. Let's take a step back now and zoom out to the biggest possible picture. Throughout history, every major currency that has ever existed has eventually lost value over time. Some slowly over centuries, some quickly, in a matter of years. This isn't a uniquely American problem, and it isn't a new problem either. The Roman Empire, famously, debased its silver coinage over decades, gradually reducing the actual silver content in each coin while keeping the face value the same. Prices across the empire rose steadily as a result. And ordinary Romans experienced exactly the same kind of quiet wealth erosion we're discussing today, just without stock markets or 24-hour financial news to help explain what was actually happening to them. The British pound has lost the vast majority of its purchasing power since the early 1900s. The same is true of nearly every major currency you can think of. This is, in some sense, simply what currencies do over long enough stretches of time, which is exactly why understanding this pattern matters so much for anyone building wealth over decades, not just months. If you're only thinking in 1-year or 2-year windows, these forces can feel confusing and unpredictable. But zoom out to a 20 or 30-year view, and the pattern becomes remarkably consistent and almost boringly predictable. Currencies debase. Nominal asset prices rise to compensate. Real, underlying value grows far more slowly and unevenly. Investors who understand this pattern position themselves completely differently than investors who don't. They stop being surprised every single time a currency-driven rally happens. And they stop panicking every single time a currency-driven correction happens too. They simply see the pattern for what it is and plan around it calmly. Let's close with the bakery one more time, because I think it ties this all together perfectly. If you owned that bakery and your revenue doubled purely because the currency lost half its value, would you actually celebrate, or would you look a little closer? Check what you can actually buy with that money, and make sure you're not mistaking a bigger number for genuine, lasting progress. That's really the question every investor should be quietly asking themselves right now. Every single time they check their portfolio and see another green number on the screen. Rising numbers feel good. They're designed to feel good. That's exactly why they deserve a second, more skeptical look, not less scrutiny. Because the most dangerous illusions in any market are never the obvious ones that everyone can already see through. They're the quiet ones. The ones dressed up as good news, sitting comfortably right there in plain sight. Go back now to that percentage gain you looked at earlier in this video. Subtract inflation from it in your head. Does the number still feel as impressive as it did when we started? For a lot of people watching this, the honest answer is probably no. And that's not a reason to panic. It's simply a reason to see your own financial picture a little more clearly than you did 20 minutes ago. That clarity, more than any single hot stock tip or prediction, is genuinely the most valuable thing any financial video can offer you. Because markets will always have cycles. Currencies will always rise and fall. Headlines will always oversimplify complicated stories into single, dramatic numbers. But your own understanding of what's actually driving those numbers, that's something nobody can take away from you. It's the one edge that compounds quietly in the background, year after year, regardless of what the market does next. So here's my honest final take on where things stand right now. Right. The current gap between a resilient-looking stock market and a genuinely uncertain economic backdrop is real. And a meaningful part of that gap is being explained by currency weakness, rather than by companies becoming fundamentally more valuable. That doesn't mean a crash is imminent. It doesn't mean you should sell everything tomorrow morning. Markets can remain in this uncomfortable, stretched-out state for a surprisingly long time, sometimes for years, not just months. But it does mean you should hold your expectations a little more loosely than the headlines encourage you to. And it means you should watch bonds, gold, and real corporate earnings just as closely as you watch the stock market itself. Because those are the instruments quietly telling you the fuller story underneath the surface. If you take just one thing away from this entire video, let it be this. A rising number is not the same thing as rising wealth. Always ask what that number is being measured against, because the ruler matters just as much as what you're measuring with it. Now, I want to hear from you. Do you check your portfolio in nominal terms, or do you already adjust for inflation in your head? Drop a comment below and let me know, because I read every single one. And if you learned even one new way of looking at the market today, that's genuinely the entire goal of this channel, not to predict the future with false confidence, but to help you see the present more clearly than the headlines usually allow. If this kind of deeper connect-the-dots analysis is something you want more of, consider subscribing, because this channel is going to keep pulling these threads together going forward. There are plenty more of these hidden patterns sitting quietly in plain sight across the financial world. And we'll keep digging through them together, one video at a time. If you found this valuable, consider sharing it with one person in your life who only ever looks at the headline number. Sometimes the most useful gift you can give someone isn't a stock tip. It's a better set of questions to ask about the numbers they're already looking at every day. Thanks so much for watching all the way through this one. I know it was a longer, deeper dive than usual, but I genuinely believe this is one of the most important concepts for any investor to internalize. Understanding the difference between nominal and real returns will serve you for the rest of your investing life. Long after this particular market cycle has come and gone. Long after whatever headline is dominating the news this week has been forgotten. That's the nature of truly useful financial knowledge. It outlasts any single news cycle. It outlasts any single market cycle too. And it quietly compounds, just like the best investments do. So keep asking the deeper question. Keep checking the ruler, not just the number. And keep coming back here, because we'll keep exploring these ideas together. One chart, one pattern, one uncomfortable truth at a time. I'll see you in the next video. Take care of yourselves, and take care of your understanding of your own money, because in the end, that understanding is the real asset. Everything else is just the number on the screen. Thanks again for watching. Until next time.